But yeah, look, only took us about a year and a half to get started.
Right.
All right, so first subject, jumping into it, we're going to go on more deep dive fundamentals, the dark side of traders. So first thing we're going to be talking about, jumping in, debt ceiling, short versus long term, good versus bad, how we see this affecting the S&P, the Nasdaq, specifically in the market. If you guys don't know, this is Cajun. He's been in the Discord since the very, very beginning. And this is what I always say. You know, the goal of Discord, the goal of, in my opinion, building communities overall is getting people ultimately that become better than you in certain aspects, and then you all help each other along the way. Cajun has been probably the most, I would say, dynamic in Discord that's also focused on, fundamentals along with me. But besides that, really meshed. And so anyone is going to be doing this talk with me, Cajun's definitely going to be the one. Everyone from Discord knows them. So let's get started. And I think people have been excited about hearing about the debt ceiling from Cajun, because Cajun is definitely is the word. I don't know if the word's necessarily bearish, but it's not good. So I'm gonna let Cajun go first, give his viewpoint on the debt ceiling. I don't know if you listened to what Biden said this morning, Saturday.
He says a lot, but what specifically?
So we kind of had, in my opinion, we had McCarthy kind of come out into this week, and he was giving a viewpoint of we might not really get a decision figured out right this week. And then Saturday morning, Biden kind of comes on and says we're making progress, we're moving along, but it's hard to, his exact words are, I think we're moving along. It's hard to tell. We have not reached the crunch point yet. We'll know more in the next 2 days, which, again, I think it's important that we don't get our hopes up.
I think when it comes to the debt ceiling, I've been on it, since last year. I think the biggest thing for me is realizing what kind of got us here, and all of it leading up to it from a market's perspective was inflation, and what type of inflation. You could say the Eurozone was energy. We could say that here, but it's possible that maybe we just experienced a pretty big hyperinflation from all the spending, which started with the Trump era with COVID, which was necessary spending, and then it rolled over into the Biden administration. But then what we've seen, the debt ceiling talk that we're in right now, actually started last year, October, November, when it really started to get serious, and we knew that there was going to be a deadline coming down here. Well, if you look back to those times, that was the end of the last big funding bill that we had. So all of a sudden, we had that funding bill, and that's when last summer inflation expectations and the growth of inflation was at all-time highs. Since then, inflation is still, I guess, trending a little more worse than neutral, trending up, but at a slower rate, right? So it seems like we're gaining ground. But remember, we haven't had any big spending bills. And this is the first time in 3 years span where we don't have any big spending bills on the table. So like my concern right now is a few things, is with this rate pause caused to the debt ceiling, why are we doing it? And we can get to that a little bit later. But
say the last part again, the rate pause.
The rate pause with the feds, it's like, why are we doing it? And you and I have talked a little bit about that, in the sense of, well, a pause traditionally would be because we're gaining ground on inflation. But back to what the point I was just making was, we haven't had any big government spending, which in the last 6-8 months, I think it was October, August when they passed that last one.
There hasn't been anything.
That's right. So what I'm saying is, all of a sudden now through December and January, you saw that big decrease across CPI, PPI, you know what I mean? And we went through it and we're like, oh, okay, we might be gaining ground. Then we saw shock in February. And then now it's like we're managing expectations. But remember, just like earnings, inflation expectations are just a little less bad. They're still bad, but we're meeting those poor expectations, which,
yeah.
So like you have to look at that both different ways. But now, with that said, now back to the debt ceiling, it's coming to an impasse. If we haven't had if hyperinflation was our inflationary problem in the US, forget Europe for a minute. If that was, and I can't say that it was, but I've always been, me, I've been pushing like, man, you can't handle this spending. So anyways, we see a period of time without government spending, and here we are, right? Well, we're talking about a rate pause, but the only way to negotiate a debt ceiling is to increase the limit, more spending, right? So does it push you back into maybe not hyperinflation, because if the Republicans get their way, there's a lot of cuts that come with it. So it would be maybe a little bit more neutral and seen very well if we have cuts. Otherwise, if you go with what's Jamie Dimon wants to see and Democrats want to see, a conditionless debt ceiling, then now you enter hyperinflation again.
So I think it's a good point. I think it's a good point. And I want to cut you off, but I want to kind of go over the different view that you're bringing, because I think that's something that has not been discussed enough. I think this is important too, while we do like the voice versus just ranting in Discord, because sometimes you miss the points. So what Cajun's basically saying is, if we look at what's happened from really, let's say, I mean, I'm trying to think, like, was there big spending in, well, 2021, obviously we had some of the stimulus, obviously, but like, besides that, was there anything? I don't think there was anything else. We had the Build Back Better, but did we really actually?
Yeah, we had a pretty good, the Biden spending alone, man, don't quote me on this. I know we're somewhere in the neighborhood of 4 to 6 trillion.
But I'm saying in 2022, we didn't have that much.
You had a pretty decent bit from the COVID bill. So
was that 2022? That's what I'm trying to say, though. Yeah. Was that?
No, it was so we didn't spend a lot of money. We didn't spend all the money in 2022 from COVID. So they restructured that and they rolled it in.
Exactly. So there was nothing new in 2022. That's
it was the infrastructure bill that they took that stuff with and then put it with it. So you had the infrastructure bill in 2022, which was late summer, I believe.
Yeah. So basically what Cajun's saying is you have a government right now that isn't doing a lot of spending or new acts, which is really interesting if you think about it from like just a political point of view. And this is not us picking sides, whether one or the other side. It's just, it's really interesting when you think about it. Usually what presidents do, or someone that gets, especially their first term, is they come in, they start trying to spend money because this kind of builds their resume if they want to start, running again down the line. And so when we look at what's happening with the debt ceiling, it's obviously a major issue because it's, peaked out. And obviously this is kind of this area where you have, Republicans versus Democrats in Congress and the Senate, and now they are kind of struggling to get things to go through. And if this doesn't get passed, essentially Biden won't be able to do much. Like, he's just not, and you won't be able to build a resume. And you can say it might be halfway be a political agenda from the Republicans. I would not argue that it isn't, but I also think that it's something along the lines of, if we keep raising the debt ceiling, inflation, you would have to assume, continues to go up. And I think that's Cajun's argument here. And it's interesting because I have not looked at it from this viewpoint. I've been looking at it from a viewpoint of solely, what is the Fed doing? What are banks doing? And kind of how is the Fed attacking it? And not the underlying effects that the U.S. government could have. So you continuing this going. And I think that's kind of the track that you're going here.
Yeah, it is kind of the track. I'm more looking at it on a short term because, I mean, the spending bill doesn't necessarily would mean it'll affect us long term. I mean, I think it would in the scenario that we're in right now. But just in general, we've had a period of time. I think December, Biden laid out I think it was almost 2 trillion, maybe 1.6 or something $1 trillion year budget for the year or whatever. But anyway, so when he came to office, I want to say it was he had 2 big spending plans, or maybe 3, but it was a total of 6 trillion he was trying to get through. I know we've got through about 4 so far. But anyways, back to my original point, if we had a longer period of time where the Fed and us that constantly try to figure out these fundamentals and just follow them, we look at a period of time where what is inflation doing? And we read all these reports. I know you do, I do. I spend so much time doing it. What was the improvement, right? So we saw the energy improvement, but energy's been flat for months. I mean, realistically.
Down. It's been flat down. But
it's been sideways in a 15-point range.
Which really is, I've been kind of talking about this lately too, is what you want to see from energy. Like, absolutely. Honestly, I'm not gonna lie. I assumed energy would start spiking back up sooner. And it obviously it hasn't. It has not. And so you've kind of seen this flatlining happening, which is typically what normally happens with crude. If you go look at the chart, you're not going to get high volatile moves up and down nonstop. Typically crude gets a move and then it stagnates and then we'll get another move. And it's not guaranteed to stair step up or stair step down because the oil markets are just so
it's complex. It's moving pretty volatile, which it normally does, which is why it's left out of things like CPI and put into core. but it's moving that way in a 15, 20 point range, just literally sideways.
Well, I think
So
that's important too, because we're going to talk about that in like this kind of middle part of this is going into inflation and what's really representing between CPI and core CPI. But before we go on that, I kind of want to get like not like pinpoint you to an answer,
sure.
but like, what's your view on, let's say, by end of June, what do you think happens with debt? What's your debt ceiling prediction? If you had to throw one out there, Do you think we get one short term resolved? Do you think Biden goes through and does the whole we talked about the other day, where like he basically,
Amendment?
yeah, where he raises it, basically an emergency debt ceiling raising, or what do you think is the? So I think if he does the latter, it will be.
I think McCarthy has the support to basically hold his ground. He said he's not going to go with the short term fix, doesn't want one. He may have to budge on that because we have to remember we have a new speaker, right? He can only do so much. It was actually impressive that he passed what he passed.
Well, he did it on both sides. He didn't just do it on just Republicans. He did it on,
which was impressive, and which is why I think he intends to stick to his guns and has the support to do it.
I think he will budge a little bit personally.
Yeah, I mean, well, it's a negotiation. They have to. I would hope to have faith that they do.
Biden says he's not negotiating. So
he also said he wasn't negotiating 2 months ago, and he just put out a statement like,
I agree.
And they had the weekend talks, but I can't give you an answer. I would like to say it's going to be resolved. Maybe they go with something. Yeah, maybe they go with something that's revisited in December, which for both sides they could say isn't short term. You know, I mean, what do they call short term? I don't know.
Yeah, that's actually. Yeah, so now to add on to that, which also is something we don't consider often, is creating a very short-term, result of the problem and getting down. We like to kick the can down the road. It would make sense too. They like doing things after September, after November. So right. Kicking the can down into them would make sense. Although, I don't know, trying to get the debt ceiling resolved in his last year of presidency could.
So that's going to be a disaster.
Yeah, I'm about to say then the Republicans 100% aren't going to want to do it. So I don't know if Biden's going to want to do that at all.
But in the same breath, I mean, maybe both sides are more prepared to stop it than we think. And the game here is the Republicans want to see it stopped unless they get the cuts. Maybe the Democrats really want to see it stopped too. They just want to be able to play the blame game when the reaction that we will see happens from it. I don't know.
I definitely think there's a big political game here. I think the debt ceiling is the one area of the market that is the most unpredictable because you're leaving it up to people that, as much as people hate, they're like the Fed, they're flip-flopping, they're going back and forth, they're, failing this and that. I'm like, I don't really know if they are. I mean, honestly, the Fed they probably took too long to raise rates, but at the end of the day, the Fed has kind of said what they're going to do. And ultimately, they just keep doing what they say. Like they've said plenty of times, they're not going to pause rates until data shows us that inflation is actually either dropping or stagnating, doing something decent. And they've continued to raise rates until then. So it's like, I don't think they're going to change the story all of a sudden.
No, I agree.
So
I think what's interesting though with that, not to cut you off, is the FOMC is after theoretically Yellen said we would default.
I did not see that.
So
Yellen. I know Yellen was going crazy yesterday. She was.
So well, I mean, it's something they say. Oh, it doesn't bother them. It's for but now it's to the point where it has to bother them, and they have to start saying stuff. But our next FOMC meeting, I mean, Yellen says we should be okay through the first. Well, guess what? Shortly thereafter is our next.
Yeah, FOMC. I mean, it's coming up quick. So, yeah, personally. Man, I'm actually kind of on the same tone as Cajun when it comes to not really being sure about the debt ceiling. Again, that's like the one area that gives me doubt with longer positions in the market right now is the debt ceiling. Everything else I'm actually really relaxed about, which is kind of sounds crazy as far as looking at interest rates and looking at what's happening. I think just short term, I feel comfortable with that, but I don't feel comfortable short term with the leaders of our country making decisions, if that makes sense. And it's not even from the Democrat side, it's from both sides of it. So it's I just don't know if it's political or if it's let's just get this done. I'm yeah, so that's that. The next thing I want to talk about though is really going into CPI and core CPI. And so Cage said something really interesting. And so he was basically saying how you're moving really volatile on energy right now. And you have been, obviously, since, March, we had this crazy run where, oil went to like 112, 113, maybe a little bit higher. And then it's like dumping at like 70, 72 right now, I think. So we're at 72 a barrel. And so obviously it's incredibly volatile. Now, going from this, if you look at some CPI year over year, like regular, I'm looking at right now, 9.1% is the highest. Right now, you're sitting at like 5.49, I think is where you're at now. But you look at core CPI over the past, basically since December, you've been in a range of 5.17 to lows of 5.5. So it's like you're not moving, right? He's like, you're stagnating or doing nothing. Now, in my opinion, this is totally based on my opinion. I think the Fed wants to, because you asked the question before, like, why are they doing this? And I think we've talked about this pretty in detail. I don't think the Fed wants to shock the market right now, personally. And I think that by what they're trying to do with, raising rates on credit specifically, and I think this is their own little makeshift idea of attacking consumers. They're like, look, if this isn't going to get unemployment to rise or increase costs, they're like, we don't know what will, like, without, spiking inflation. And so I assume what my thesis is that they're going to try to pause, and I think they're looking for a reason to pause, to be honest.
Absolutely. I would agree.
I think that's why I look at it from the thesis of short term. I have to like the upside. If our Fed is looking to pause, now again, I'm not saying a pause is necessarily fundamentally good, but there's a difference between what we think is fundamentally good and what the market reacts to and trades in a direction.
Not to cut you off, but with that, what did Bullard say today? You know what I mean? You posted, brought it to my attention, didn't even know. Bullard said market-based inflation expectations are back down to levels consistent with the Fed's 2% inflation goal, right? So,
I agree. Yep.
So with that said, if you see potential upside, markets price it in. We're neutral. So if the Fed is going to pause, and that's the expectation, it's priced in, because that would be the plan if they're on track to see 2%, right? So in my opinion, any good news there, maybe it garners that, but now you weigh the risk of any poor news. And then with a pause, if the debt ceiling wasn't on the table, I'm permeable if they would pause. The problem is there's so many, you already have a credit issue. You're going to attack housing a little bit more anyways with the consumer. So we're going to have a housing issue, which was actually kind of flattening out and getting a little bit better. So we'll be back on that. Construction's going to continue to take a hit. So if we were pausing without and the debt ceiling was negotiated back in November, I'm like, okay, I like it, right? We get a good data collection and we don't have anything else. We still have a banking issue. We still have a credit issue. And the pause right now, while I still like it, is the problem is if the market has priced in really good, says basically it's market's confident that the Fed has done its job and it's on plan. The problem is I don't disagree. I think the Fed's done a pretty fantastic job, and I think they were just late to the party. But
they were forced though. Like,
wait, I agree.
I think we agree on this. Like, I want to say it before we go too far, before people start commenting and going crazy. Like, the Fed could not. Like, we have to understand the Fed could not raise rates while people were not allowed to go to work. You have to understand that. Like, it's just you can't do it. No matter what, you couldn't do it. It's like
I agree.
This is a once in like the history of the Earth event, like where people could not leave their homes and go to work for a year or a year and a half.
We still waited about 8 months too long. You know what I mean? They should have.
They should have.
We wouldn't have to go. We wouldn't have to go so fast, so hard. But you know,
it would have also been nice if we would have had some of these stimulus checks hitting people while rates were going up. It would have been a little bit more counterintuitive. Just
I agree. So I guess that's my fear. I mean, I wouldn't even necessarily fundamentally, I'm a bear. It's just because of what's kind of all on the table from a political and geopolitical front.
Yes.
But as far as the market goes, I guess the concerning part, I mean, I've been just swinging, not really day trading. And it's things like this. If the market is going to sit here and price all that in and say, we're pretty comfortable here, that leaves so much indecision, which we all know isn't good for the market. So now, whenever we go into things like FOMC, whenever we go into the beige book, whenever we go into CPI, PPI, now any negative, maybe a bigger knee-jerk reaction which makes you fearful of the upside. Because I mean, things like Apple are sitting up there in the 170s. Man, there's so much room. Take that elevator down. It's like, all right, it's forcing a bull to be careful in the short term. Whereas, in a traditional bull market, man, we could just go long.
I agree. And there's certain names that have moved up very quickly, right? We could go on the list. You can go on the list of video.
Well, you just list all the tech stocks.
Yeah, all the big tech stocks, right? We're not going to anything like that's like I say, like for instance, like CrowdStrike. It's not a small company by any means, but it's not Apple. It's not Nvidia. Like there's a difference in a company. So that I agree. That is the question mark, and that's what I always tell people. I'm like, I mean, obviously, I'm not saying grab long-term positions on Apple at 2% away from 52-week highs. That doesn't necessarily make the most logical sense. Or right now is the time to go heavy on Nvidia calls while you're sitting at 290. Jay was selling like 70% of his position that he's bought, from last September at like $100, right? So it makes sense to be reducing your risk as you're getting here. Now, I just always have to make a difference and kind of go over like a short and then a longer term viewpoint. It's like, which some people struggle to comprehend that's what I have to do, but it is. So I agree with your sense of bad news versus good news now. I agree. But I also would say that I don't really think it's changed that much in the past few months, though. I think any bad news, if we really look at the past year, anytime we've really dropped on the NASDAQ, and we just haven't had really bad news in the past like 4 months regarding inflation numbers spiking. Like we had that one like little tiny jump and then it kind of flatlined and went down like it went up like an inch and went down a centimeter, and that's like basically like the best analogy I can give. And so that was like the only kind of scare we had. But when we look back at like last year, we had Jackson Hole, and like I mean I can say all these days when
you're at Jackson Hole spot on a lot of stuff.
XLK is there or right above that actually, and then you have Q's. ES is close. ES is definitely lagging, but that's just because the sectors in it are the ones getting hit the hardest. Banks and industrials are getting hammered right now. We look at I think what is
Absolutely.
it? XLI, XBI. What is it? I think it's XLI. Anyways, so those are getting hit. Like so, people are like, well, ES isn't breaking out. I'm like, I mean. Well, I'm not really looking at ES. I'm looking primarily at tech and how it's been responding. But
XLI is still well above the 200.
So I think Cat's been getting crushed. It's been since those earnings though that have been coming out, and earnings were very telling across the board. So I think as far as looking at what the Fed's doing, I think personally they're getting a little bit. I don't know what the word's desperate. And again, it's hard to use these words and then say like and try to like explain how I see potential upside in the short term. But it's really just I think the market is like that the girl that's boyfriend's cheating on him, just looking for any reason to keep the spark alive.
I guess I could agree, but I guess we all know like how Apple brings ES with it, right? I mean, I want to say it's like a total of 6% of ES.
Yes.
Anyways. So I guess what I mean is you have seen a little bit of a disconnection, right? It's moving at a better pace than the S&P.
Yeah.
With that said, if you wanted to be a bull and Apple needs to get above 176, okay? If Apple gets one at 176, you would assume the S&P goes too. Well, ES has another wall ahead of it because it's at one. I mean,
what has the next wall above 4,200,
43,
which is it's like 4,330. That's
so
Jackson Hole.
You only have you have 200 points, and it hasn't even visited.
I agree. No, I 100% agree.
So I guess like I'm with you, and I know y'all been playing equities really well, and because if you're gonna be a bull right now, equities where it's at because of how they've outpaced indices. So, but to be a bull, you have to remember that you outpaced them. And then even at some point, you have to get back to a connection between the two.
I agree.
You still have some really big stuff ahead of you.
Well, this goes back to what we were saying in December when obviously the NASDAQ was outpacing ES to the downside.
Yep.
I mean, NASDAQ continued to make lows while ES made higher lows. Like it was clear to see. And we eventually were like, look, once the NASDAQ starts catching back up and starts leading, that's when you get more bullish on equities, right? That's
Yep.
and everyone like tries to say, well, ES and Dowley. I'm like, no, this isn't 1990. No, the biggest companies in the world are, believe it or not, tech companies, right?
100%.
I get it. I get it. Saudis make a lot of money with oil.
Man, but people don't realize the tech margin is 60 to 70% on earnings. You know what I mean?
Yeah.
When you come to the books and industrials, man, 30% they killed it. You know what I mean? But average would be 18 to 25. So I know anybody for the financial background will completely understand what I just said.
Yeah.
So that's
so. Yeah, I agree. I agree in the cause for concern, and I don't think it's going to be like, again, I don't think we're going to have a 2021 market to where we just go straight up and this continues. Like we have this 20%, almost 30% rally on the NASDAQ in the past 4 months since the beginning of the year. I don't think that's sustainable. I don't. I got to say that right now. I don't think that's going to just be what happens. Like we're going to slow down. We've already kind of had a little bit of a slowdown. You're going to see other sectors start to rise back up. I mean, if you look at the NASDAQ in general, we look at small and mid caps in those names, like, we go over PayPal, Square. We look at, I hate to even say the word Roku. We look at, crypto stocks, Coinbase. So I'm just trying to name bigger ones out of the top of my head. You look at, to a certain extent, Intel, some of the even AMD lagging behind NVIDIA. You look at, CRM finally bouncing back up, going crazy. CrowdStrike, you look at Dockies, all these big cloud names that are still relative, damn near those lows still. So it'll be a giant rotation. I don't think we're just going to see NVIDIA, Apple, and Microsoft go to $1,000 on the Tesla run from 2021, if anything. But I do agree. I think any bad news regarding inflation immediately causes you to take 10 steps backwards. I think you have to be able to say where we look good up until data gives you even the slightest glimpse of bad news, in my opinion. I think if you even see inflation numbers come out a point higher, a decimal point higher, you're in a major, major danger of seeing what could happen. Because when you look at what's happening with, CPI, and even though core CPI takes energy prices out of the picture, I wanted to talk about this a little bit earlier. I just kind of forgot. It's important to realize core inflation still factors in energy, or it's going to indirectly, no matter what. It may not factor in gas prices or some of the food prices that are coming in, but ultimately, if gas or fuel energy prices rise overall, they're going to affect the cost of everything else, just as far as transportation, shipping, cost of goods, cost of running it's just consistently all going to be rising. So if there's any spike in anything like energy, that's, in my opinion, that's the really dangerous. And I think that's ultimately why this problem got so big in 22 was because of what energy did. I think energy was like, the kerosene on top of the fire. It was like, not only did we have this major issue of spiking inflation and the dog piling of this, but then we had the Russia and oil went to 120. So I think that's a big thing there. I personally believe, like I said, I think the Fed is looking for an excuse to pause. So as they're looking for that, until you get some data, in my opinion, that points you in a direction of inflation is going up, and like that's almost like it's like we look at the data, every single time CPI comes out, we look at it, we look at it in Discord, like, look, prices are still going up, but I think, and the Fed has known this because we talked about this last year in October. Like we were like, dude, the numbers aren't even really adjusting. We're saying energy prices go down and everything else go up. So I'm really careful with how I say this. I think unless you get data that makes the Fed say, yeah, inflation's going up still. I think that's the only, I don't want to say it's the only way, but I think that's going to be the point that makes them continue raising. But I don't think they want to attack rates with credit rates and hurting the consumers and do at the same time, because if they try to attack the consumers and they try to attack, because if you really look at raising rates, who it affects is big businesses the most. It doesn't affect, that's where everyone's like, oh, well, I'm not buying, who's really buying like middle class America isn't necessarily buying houses right now. Lower class America, like whether we like it or not, they're not. So if we look at what's happening right now, the upper tier America, the big companies, they're the ones getting affected. The credit's going to affect the average American and even, middle upper class more than obviously, everyone else. And so they can't attack both of them, in my opinion. And I think we see that too, because your big argument of, what's happening with margins, especially like on Amazon and Apple. And you've been a big advocate when we look at those earnings of they're not really making that much money here. And I agree from a viewpoint of they're not making money and the rates are definitely hurting them with what's happening. And there's an overall slowdown, but they're just trying to maintain market share, in my opinion, when we look at big business. I think that's their goal right now. So I think there is a concern. The biggest concern, though, is if data points to a direction of raising rates again. And again, I think for the short term, I think it's going to be hard. I think it's going to be hard for them to raise rates. I think they're going to have to be pushed to the point. They're going to have to be. I think it's going to have to be dramatic.
I would agree.
And then, and I also, we talked about this a lot too, as far as interest rates. I think people think pausing means that they're saying inflation is handled. I don't think that. I think they're more pausing with the expectation that they're going to have to raise again down the. I think that's honestly what's happening too, because if you get to, what are they at, 5.2 right now, 5.25?
Yeah. Yes.
So I don't think you want to get to 7%. 7% would be like, I think that's like unmanageable. You can't get to 7% on rates. That'd be crazy. That'd be like, could you imagine like America at 7% interest rates? That'd be mind-boggling.
It'd be wild. I mean, but in the same breath, you might still see other interest rates, affected by the bank with the credit issues going on. You know what I mean? You might see home loans go to 9 and
no, I agree.
So yeah, but I mean, as far as what the Fed needs to do,
that's what I'm saying. If they got to 7, imagine what a home loans would be 11, 10%.
Absolutely.
So I think that's their area of, if they do too much too quick and they don't try to assess where they're at first and say like, maybe we've gotten there. That's what the whole tone from Bullard is like, maybe we're restrictive. I'm like, I don't really know how you could say you're restrictive enough yet. I mean, I'm a cheerleader for it. I'm cool, happy, but it's like,
from a data standpoint, I would be really interested in seeing a pause just to see if wage growth could continue to go and see if we could actually get some help from wage growth instead of trying to fight this trend and kill it. Pause rates and let's see what happens in that avenue.
Exactly.
Because employment numbers, unemployment numbers have gone up a little bit. Let wage growth happen and let's see if we can bolster the economy that way. While energy prices are, I guess, they're low, but we'll never see low again.
We're not gonna. I mean, so, COVID, we went negative.
That's right. But meaning we have things we have to do structure for infrastructure. We've got to refill the SPR. We've got to do stuff, right? But ultimately, we're pretty low right now. So I would be very interested to see if we can continue this wage growth and if that could actually help us. Which the Fed has really wanted to see the other thing, but in a lot of things have changed, you know what I mean, in a micro aspect or a macro aspect with the way businesses have chosen to operate through this time. You're seeing it with Apple doing $90 billion buyback at highs. You know what I mean? Like CEOs have figured out how to weather the storm pretty well. So even through the layoffs, we've had massive amounts of layoffs over the last year. So, I mean, I really would like to see a period of data collection where we are paused and see if wage growth maintains through that. And if it does, there may be some light at the end of the tunnel in a different avenue than what you would see traditionally on the books that they're trying to chase. And you know what I mean? The data points that they're trying to reference.
And that's another big thing we have to realize is like, you're not going to know if it's working until you stop.
It was the same.
You won't know.
It was the same thing. Remember whenever they were just going nuts. And I mean, back in September, October, I was sitting here like, man, I just wish they'd do 2.5 and say, we're going to do this for 6 months. Whether it works or it doesn't, at least you have a constant in the data collection. And we go 0.5, 0.5, 2.5, 0.5, 2.5, 2.5.
They said, let's do 0.75 for 6 months.
Well, I mean, hey.
No, they actually literally did it. Like, I think it was 4 months actually.
But, yeah, but you know what I mean? But like, what I'm saying is like, whenever they were like, okay, we're going to go, let's not go from just drastic rate hikes to really low rate hikes and back and forth. Just go with a constant. That way you have a measurable data point while everything else in it is changing. At least you can only control one constant and it's your policy. So just do it and do it for a long enough period where you can see if that policy was what was working. I honestly don't think we've done that yet. So a pause, I'm all for it. Just do anything for 1 quarter. That's all I ask.
Yeah. And then On top of that too, I believe again with, and it's not even me trying to justify a pause. I'm just trying to give people a viewpoint of what a pause does. If they do the pause as well and they start attacking credit there specifically, they're going to get an answer on what's really driving inflation. They're going to get an answer. If it starts to actually drop inflation, we start to see CPI and PPI benefit from that, and PCE, they're going to be like, okay, well, we know this directly. It's consumers spend, which we go figure. We've been, since the Trump administration, we've been on this consumer spending craze. Like everyone, it's just the day and age we live in. Everyone's like, oh, look, let me put that on my credit card, that T-shirt. I'm like, a T-shirt on a firm credit card? That's crazy. Like, what are we talking about? Like, that's just where that's our market now. That's just people in general. So I definitely think you're going to get more answers, and that's the only way you're going to get the answers. And I think that's also important to realize. People get saying, well, if we do this, then inflation's going to keep going up. I'm like, we need to pause for a second, because inflation did in fact continue to go up when we were raising rates from the beginning of 2022
and it's continued to go up as we've gone down as well.
Exactly. So. And employment numbers continue to go down. Wage growth continues to slowly. It's slowed a lot. It has slowed a lot.
Yes.
Which, it slowed down a lot. But like, it's important to realize that none of the problems have been solved from raising rates at the fastest rate in history. We've never done this before. I don't think we've ever done 12 hikes it's like 12 hikes in a row now at this point.
Yes, it's pretty wild.
Yeah, it's like it's incredible. It's like Kobe in the fourth quarter. They just keep doing it. They just keep shooting. And they're like, what if eventually, I guess, something will work? And so that's what we're doing right now. And so I think that's just the point that we're getting to. And again, short term, the pause, like Cajun said too, it's creating this narrative that it's like green pastures ahead. I think that's what that is, the narrative. But we have to understand the dangers that come with that as well. If we start to present this idea that, we're in the right direction, inflation may be getting behind us, even if the Fed pauses and they're like, inflation isn't behind us, the market's still going to price in the fact that inflation is behind us. It's just what's going to happen. Like, you know what I mean? Again, we've never raised rates this quick. We've never done 12 hikes in a row. This has never happened before. Okay. So I think, and then we're also in this area of crazy innovation right now in the market where everyone's like this AI craze. It's like, I'm not going to say it's a .com bubble all over again, but it's like this whole new area of market that's replacing workers, giving you the best data that there is out there, increasing productivity across the board. And every company in the NASDAQ wants to use it. I don't know if there's any company in the NASDAQ that does not want to add AI, Chat GPT, or some other integration into their workflow. Right. And I don't know the last time we've had this, maybe 2020 when everyone started working remote, but it's like we just saw two drastic shifts in the economy. And we haven't had, from 2000 probably to 2020, the economy was gradually shifting slowly. 2020 was a leap. We took like a 5-year jump. And I think now we're taking an even bigger jump. And so I think that's where we're at now. And I think it's just, again, people hear me say it all the time, is patience is like your best friend. But again, I think short term, if the debt ceiling gets handled, pushed down the road a little bit, which it's looking, you have to imagine. I don't think if you're gambling on this based on history, unlikely they default. But with this administration, I think anything truly is possible. But yeah, that's kind of our view here. I don't know if you have anything else you want to add up on this.
No, not really.
That is pretty much it. Last thing we'll leave with, few plays that we're liking. I don't want to put Cajun on the spot. For myself, I think, and then this is something we've been talking about heavily, as far as I just like looking at undervalued names here personally. I've been a big fan, but they've kind of started running, so I don't like to say them enough. And maybe I'm being, a little skittish with the calls that I like. Amazon, Google down at lows at $100. I think that they were incredible. But I think personally, if I'm grabbing something safe long term, don't shoot the messenger. And I've been slowly creeping this in there. I think energy plays, as far as like not oil and gas personally. I think down the road, as far as, and I don't like clean energy. I'm not a fan of clean energy personally. Attack me, sue me. And Cajun may not like it, but I liked GE going into the beginning of this year, and I like just overall straight to consumer power names. Those are the ones that I'm a big fan of here. I think that's coming on to probably the top of my list as far as safe names for myself as well. Like 2022, it was all oil and gas, oil and natural gas. I was screaming at the beginning of the year. I thought it was the safest. I thought you could put money in it. You can get dividends if you wanted it. I thought overall that was just like you put your money in it, you were going to be happy. There was no way it was going to be bad. This year, I think you're buying into a little bit of a tricky market. I think energy names are going to hold up and stand the test of time over the next 2 years, personally. Now, I'm not talking oil and gas, so don't difference here. Total difference here. And then if I'm looking at tech names, I'm not going mid caps. I'm not going small caps right now. I don't believe in them at all. Actually, I have zero faith in them. I think they could be terrible. So yeah. What about you?
Man, I'm kind of with you a little bit there. I am so neutral. I don't know if I've been this neutral in a year. I'd love Costco. I really do. I think if it's going to get a chance, it's going to get a chance here. But in the same breath, I think Costco's just above a 200. I was trying to pull it up a minute ago.
It's at 504.
Yeah, but if you put on Costco on like a daily, if you have it pulled up, if you put it on a daily, you'll see like this massive trend line ahead of us. And I think we at least test it. It gives us a little bit there. You lose the 200, you go there. As far as energy, I think Zom's an interesting one to watch here. And I've been watching it pretty hard because, as you know, a couple months ago, you were like, oh, I love energy here. And I'm like, no, man, not yet.
Yeah, you fell through. What was like 82 on crude?
You went all the way to 200. So you just broke the 200 for the first time since March. And you had to close below it. So it's really interesting here because a break below would be the first time in a long time. So I like the reaction here. I think you probably get back another visit to 110-ish, 115. Other than that, man, I'm neutral, and you know my position on the Qs. So that's a fundamental long-term play for me.
Yeah, and I'm with Cage on Exxon. I wouldn't be looking at CVX, Chevron. I wouldn't be looking at Conoco. Oxy, everyone knows Warren Buffett. I think the craze there is gone, though. Total different operations.
He
sold. Did he? Did he sell again?
Yeah.
I know he said he wasn't looking to get majority.
No.
I know he publicly came out after that and said he was not publicly looking to get majority, even though he got permission to do it, which was weird that he went and got permission, and then he came out and said, yeah, I don't want to do it.
So
he does own Dominion, though.
Absolutely. And what's interesting to know there, he bought that for carbon capture play.
He bought that
in my opinion,
COVID too.
That's right. But he bought Oxy as a carbon capture play. The reason Zama stayed where it has was natural gas. It's an oil and natural gas company, right? I mean, that's just literally what it is. It stayed up here. Why? It's the largest carbon capture operation in the world. So if you want to go that avenue of clean energy, guess what? They do it. They do it the best. So that's why it's a value here, in my opinion, and it's something to watch. Gotta wait for it to get back above the 200, test it. But that's one I kind of like if we do.
It's important to realize too when you're playing carbon capture, a lot of the big money that's going into these names are betting on long-term legislation and laws being passed into that. So it's not like they're playing this for like a shorter term. Like, I mean, Buffett, it's funny because he's a big holder, but as of recently, he's been a swing trader. If you really look at it,
has
TSM, Activision, he might actually turn a profit on that name. I kind of couldn't believe he did it. He was like, worst case scenario, the deal falls through. I'm like, okay, that's a weird worst case scenario, but whatever. But like Exxon, or not Exxon, Oxy, he's been getting in and out of that. Still owns a large majority, has
Absolutely.
a lot of, but he's definitely pivoted in his strategy. So it's important to realize though that when you're playing carbon capture, if you're playing something for that reason, you are playing like a longer game there. Now you might see some upside in the short term, but yeah.
Not only that, but you want to be playing. I mean, I want to be playing one if I'm going to play carbon capture that's in the oil and gas industry, because that's a footprint, right?
Yeah.
Biden said over the past like 3 months, he wants to refill SPR. He has to do that before he leaves office or before he starts doing I say leaves office, before we have the next election cycle,
It'll look really bad if he does not.
they will literally just attack him. So could oil go back into the low 60s? Absolutely. I mean, not oil. Yeah, oil 62. But
I mean, it's near their
Zom
buy
could
target.
Zom could fall to like 91, maybe, but not super worried. But I guess what my point is, if he's going to go there on that route, uplift cost probably offshore for Zom. I'd say it's somewhere in the mid 40s to low 30s to mid 40s, depending on their location. That's price barrel coming out of the ground. So anything above, I'd say $40, they're profitable. And then on land, it's way lower. They're in the 20s. So if he says he wants to buy it at 70, guess what? Oil companies, gas companies, they're green. They're making money, right?
Making good money. That's
okay.
Still.
Okay. So think about that. So they're making money. All right. That's locked in. If he starts filling at 70, we're good. Nobody's losing money in the oil industry. So now if we can start getting legislation there on a carbon capture front, then Oxy, Zom, that's your names. They're the biggest ones. Well, Zom's by far the biggest. So, I mean, it's something to look at long term, but like just in the short term, if he starts, that might be part of this, what we're about to see with the debt ceiling. The Republicans would absolutely allocate money to refill it because it's going to look good.
Yep.
So I guess what I mean there is like there's opportunity both ways. And if we look at oil and it's something I like, and I mean, it's something, I trade more than anything, but if we're looking that way, then that's what I'm looking for, because if we start filling it, it's like oil used to be hedged, right? Company would come in, say, hey, for this quarter, you're my buyer. What are you going to give me? Well, let's meet in the middle. I'm going to give you 70. Well, no, it's 80 right now. Well, yeah, it's 80 right now, but I'll give you 70 for a quarter. All right, cool. So I know I go to this whole next quarter and I'm locked in.
The expectation. Yep.
Right. So anyways, that's what interests me in energy right now. Is there room to go a little bit lower? Absolutely there is. This debt ceiling terrifying? Absolutely it is. And for me, I just got to wait. I got to wait until we have a resolution there.
All right. That is it. See you guys next week. Have a good one.